Welcome back to More Fun with Finance. I'm Dr. William Elliott, coming to you from my studio in beautiful uptown Shaker Heights. So this lecture is all about determining what projects to take on for a company. We're going to use a variety of different rules and look at the pros and cons of each. At the end of the day, we're going to find that the NPV rule is the rule that optimizes the pros over the cons and will be the one we'll use. But many people use other rules. IRR, modified IRR are variations that give similar results to NPV, but then there are some others that don't give similar results to what we find with NPV and may actually lead to suboptimal decision making. Anyway, so without any further ado, let's get on to the slide deck here. I will get out of your way, and here we go. So here is the list of the various types of rules that we're going to look at. First, we'll start with NPV, the net present value, and then we'll talk about the payback rule, discounted payback, average accounting return, IRR, or internal rate of return, profitability index, and then some other details about capital budgeting. All right, so the big question that we're asking here is, what projects should we take on as a corporation? What projects are going to add value to the corporation? We're going to look at both independent projects as well as mutually exclusive projects. Independent projects being those that we could take on independent of anything else. We could have multiple independent projects. Mutually exclusive projects are 2 or 3 projects of which we only take on one. This is in particular where NPV shines, is being able to tell us which one is actually going to increase the value of the firm the most, even over rules like internal rate of return. All right, so here we go. Let's start looking at NPV. It's essentially the difference between the present value of the future cash flows generated by a new project minus the cost of that project. And if that number that results in that subtraction turns out to be positive, generally speaking, we'll take the project. The more positive it is, the more value it adds to the company. In fact, we could actually say that the value of a company is actually the sum of the present values of the individual projects that that company owns. All right, so let me jump over to this slide. How do we actually go about estimating it? Well, first we have to estimate the future cash flows, and that's a non-trivial task, certainly done with a significant amount of error. The other thing that we have to estimate is some sort of discount rate that applies to this particular project and is consistent with the riskiness of the project. And then finally we subtract off the cost of the project. So discounted cash flow valuation is something that we looked at in a prior chapter when we looked at stock valuation. You were looking at discounting dividends. You can discount free cash flows, things of that nature. And that's effectively what we're doing here. So here's an example. Let's look at, and let me grab my pencil here so I can highlight things. So we have a fertilizer business that we believe will generate revenues of approximately $20,000 per year. Cash costs will be $14,000 per year, and the business will be finished in 8 years. Plant, property, and equipment will be worth $2,000 at the time of the end of the business as salvage. The project will cost $30,000 to launch, and the appropriate discount rate here we've determined to be 15%. And then we're also given that we have 1,000 shares of stock. So the question is this a good project? All right, so first off, let's look at the present value of the future cash flows, and then we'll subtract from that the cost of the project to get our net present value. So the future value of the cash flows are going to be the $20,000 revenue minus the $14,000 costs. and that is, and we can consider that an annuity. So we're actually plugging it in here to our formula for a annuity with 8 years on it. Notice the 8 exponent there. And then the other component is the residual value or the salvage value of the equipment, the $2,000, which will also discount back at 15% for 8 periods. So when we actually do that math, we come up with a present value of those future cash flows of $27,578. Now, when we subtract the cost of the project, the $30,000 upfront that we pay for this, we find that we end up with a negative $2,422 in net present value. So effectively, this is a losing project. It's costing more than it will generate for the firm. So we would decide against taking on this project. Now, in the real world, of course, revenues may be greater than $20,000. Costs may be less than $14,000. So there's possibly some probability that this project would be viable. And we'd certainly, on any of these, and by the way, this would be true for any of the measures that we use, we would want to do some sort of sensitivity analysis to see just how many probabilistic outcomes are negative versus positive. If we look at this on a timeline here, here is our 30,000. This is in thousands, of course. Here are our revenues in each year. And then that final year, we have not only the 6,000, but we also have the 2,000 residual value. And just to put it in time frame form so you can see where things are chronologically. I would recommend, again, using timelines whenever you can, especially on the more complicated projects where you've got multiple cash flows. So here's another example using the NPV rule to value a project. This particular project is a new consumer product to be launched soon, and they have projected a 5-year life of the project, and there will be $2,000 for the first 2 years, $4,000 for the next 2, and $5,000 during the last year of the project. And the cost of this project is $10,000 at time zero at now, today. And the discount rate that we are told is appropriate to use is 10%. So when we do the discounting, here are the 5 years and the 5 different cash flows. We come up with a present value of those future cash flows at a discount rate of 10% as $12,313. Now, since the cost of the project is only $10,000, that means that the NPV, or the net present value of this particular venture, is positive to the tune of $2,313. So this would be a project that the NPV rule would suggest that we should take on. We'll talk about mutually exclusive projects later, but ultimately, if we had, say, 2 projects, we would take the project that had the highest NPV, meaning that it would increase the value of the firm the most if we could only take one of the 2. Now we move on to the payback rule, which is probably the worst rule around when it comes to actually trying to make projects work. Back when I was working in industry, I worked for a small company. We built fiberglass powerboats. It's called Glastron Boats. And the CEO of that firm used the payback rule. This was the time when computer numeric controlled routers were just coming into being, so CNC routers. We cut a lot of wood parts. Actually, you might be surprised that a fiberglass boat has so much wood in it, but there's quite a bit, mainly plywood. So we would route these pieces by hand on these very large routers, and the pieces would be dipped in preservative, put on a shelf, and we'd have an inventory for each of the models of the boats. And we put together quite a few different models, I would say on the order of probably 30 different models. And we'd build anywhere from 10 to 20 boats a day. So it's a fair amount of inventory to hang on to. We had a paint schedule that was usually issued the week before, And so usually there was a significant amount of inventory on the shelf ready to go to support production. Problem was is that it required a lot of labor, it required a lot of space, it required a lot of material, and with the use of a CNC router, it could have been much more efficient, labor saving for the firm, and ultimately it was what they moved to. But because his payback rule was a 2-year payback rule, and CNC routers at that time were just being produced and marketed, they were very expensive, and I could never make it pay back in 2 years. It would pay back in 5 years easily, but not 2 years, so we didn't do it. Ultimately, the company didn't do well against some of the competitors, partly because those competitors had lower costs because they used CNC routers. But nevertheless, this is the payback rule. Still used today too. That was about 40 years ago, but there are people still using payback rules. It's not terrible if you want to keep a great deal of liquidity, but it causes you to pass up some potentially positive value projects, positive NPV projects. So if we use the two rules together, payback might say don't do the project, whereas NPV would say do the project. You should listen to the NPV. All right, so how does it work? Well, we set some sort of arbitrary payback period. We want all of our money back in X number of periods, X number of years. And when we talk about all of our money, we're talking about nominal amounts of money. We're not talking about present values, and that's another one of the problems with the payback rule. It just deals with nominal values. It doesn't deal with the present value, which is also a problem. So nonetheless, let's look at an example. So here we have $50,000 expenditure. In the first year, we get $30,000 in cash inflow from the project. Second year, we get $20,000. The third year, we get $10,000. The fourth year, we get $5,000. And so this particular project would pay back in 2 years. And what we mean by payback is that the sum of their cash flows, the cash inflows, is equal to the original price of the project. So we just keep adding up the cash flows until we hit the actual price of the project, and that's where we stop. We ignore everything else out here. Not a good thing as well, right? Another problem with payback rule is it ignores cash flows. These are real cash flows, presumably, and it ignores those. But this one would have a payback of 2 years. It would have met Keith Orm's payback rule at Glastron Boat Company, but we don't know whether it would meet the NPV rule. We're not given a discount rate, so we can't even test that assumption. So that's also, as I said earlier, one of the problems is that we're not discounting any of these. We're looking at nominal cash flows. All right. So let's look at how this would work for a variety of different projects. And so we've got projects A, B, C, D, and E here. Project A has a $100 cost, and then it generates cash flows for 4 years after that. We've got 30, 40, 50, and 60 are the cash inflows. So we're looking for what are the first cash flows that sum up to $100. So we've got 30 plus 40 is 70. So about midway through, a little before midway through the third year, we've summed up to $100. So, and in fact, that comes up. Actually, I take that back. It looks like it's a bit more than 2 years. Sorry, my mistake. So it's 2.6 years. That extra $30 that we needed comes about 6/10 of the way through the third year. So that one would have a 2.6 year payback. If we were using 2 years as our rule, as our bench or as our cutoff, this project would not be taken. Project B, if we look at that, we've got a $200 cost, and it only generates $40, $20, $10 in cash flows. And of course, that one never pays back. Also, if we did this with an NPV, I can already tell you it's definitely going to fail an NPV rule as well. Regardless of discount rate, because it just doesn't even have $200 of nominal cash flows in the future, much less discounted cash flows. Project C has a payback of exactly 4 years. And again, we can see that by taking the 200 here, and then we add up the inflows. 40 plus 20 is 60, plus 10 is 70, plus 130 is 200. So that's exactly a 4-year payback. Project D has 2 different payback periods. It has 2 years and 4 years. So the 2-year part of it, this one has a cash outflow at the time that we begin the project. It has another cash outflow at year 3. So the first one, the first cash outflow is $200. Add these first 2 cash flows together, and we have our $200. So at the end of year 2, we have our payback. But to continue the project, we would have to spend another $200, and that would generate a final $200 cash flow out in year 4. And again, that's where we get the 4-year payback as well as a 2-year payback. Now, in terms of discounted cash flows, it doesn't look like it would meet the NPV rule, regardless of the discount rate, because we only have the nominal amount of cash flows coming into us that's equal to the nominal amount that we paid. In other words, we have a payment of $400 over the course of the project, and we have cash inflows of $400. And if I start discounting those inflows, obviously that's going to add up to be less than the cost of the project. And then this final one, Project E, has a payback of 6 months. So we pay $50 to start with, and then we generate $100 through year 1. So halfway through year 1, we would have our $50 paid back. The problem with Project E, and the problem with ignoring future cash flows, is that there's a massive cash outflow in year 3. You could think of this as one of the other examples we're going to see in here is a mining company that has to go out and reclaim the land and do a bunch of remedial work on the mine, and that could be a firm, or it could be a project like this, where there's a very large cash outflow at the end of the project, as well as a moderate cash outflow at the beginning of the project. All right. I don't think we need to analyze this rule too much further. This is another example of why it's problematic. We've got this long project and a short project, and it looks like in the long project we have a 3.5-year payback. In the shorter project, we have about let's see. We need to be 150. We need to be about 1.75 years here. What it does, though, is that it favors shorter term projects. It biases against longer term projects. And here's the data that I just mentioned to you and how they arrived at it. Now, they also show you, suppose that we used an NPV rule instead, and we had a discount rate or cost of capital, required rate of return, of 15%. What would the NPV rule tell us? Well, the NPV rule would say, don't do the short project because it has a negative NPV. The long project, though, has a positive NPV, so that would be one that we would undertake using the NPV rule. Redeeming qualities, well, we're very short on redeeming qualities for the payback rule. I think the best you can say for it is that it is biased toward liquidity, and certainly liquidity is an important characteristic of any project, but I don't think that's enough to merit using that particular rule. Maybe you look at it and see what the payback is, but I would not use that as any sort of primary rule that makes my decisions for me. So in summary, we've got the pros are easy to understand, adjusts for uncertainty of later cash flows, and it's biased towards liquidity. The cons are that it ignores time value of money, it has an arbitrary cutoff, and it ignores cash flows beyond the cutoff date, and it's biased against long-term projects. So not one to use if you can avoid it. Now, somebody might say, well, we can fix the discounted cash flow piece of it. And that's true. There is another rule called the discounted payback rule. And instead of using nominal cash flows in the future, we use discounted cash flows in the future. So in this case, we have a required rate of return of 12.5%. We have investments that cost $300 and has cash inflows of $100 per year for 5 years. And to get the discounted value of those, we are going to look here. Here is the discounted value at 12.5%. So $100 discounted at 12.5% for 1 year is $89. $100 2 years from now discounted for 2 years at 12.5 is $79. You can do that yourself just by, simply running this equation. And this will be 89. And then obviously this for 2 years will be $79 and so forth. You should grab a calculator, just double check that these numbers work for you. Now, as we accumulate these, and let me get out of the way because I'm covering up the most important column. As we accumulate these over the 5 periods, we're looking here at this last column. So we start off with 89, then we add to that the 79, we get 168. We add to that 70, giving us 238. And then finally we add the 62 to it, which gives us 301, which means that our payback is just shy of 4 years because our cost is $300 and we have a discounted value of $300, just shy of the 4th year. Now, if we were using the regular payback rule without discounted cash flows, the payback would be 3 years. So it does make a difference. It does help, but the problem is that it's still not as good as, say, an NPV rule. The discounted payback, you can think of it as kind of a break even in an economic sense. If the project ever pays back on a discounted basis, then it must have a positive NPV, which is encouraging. I mean, at least that's a good starting point. But why bother with this if we already have a discount rate? Let's just do an NPV. Let's use all of the cash flows and discount them back and subtract them from, or rather subtract the cost of the project from those positive cash flows, those cash inflows. If we look at this, here we can see that obviously our investment of $300 grown at 12.5% for 5 years is going to be worth $481. And we also see that, we also note that, not for 5 years. 5 years is worth $541. We also see that the crossover point here with the projected cash inflows. So we've got our $100 right here, another $200 here, and so forth. Actually, we come up with a value of 481 in future value. Now, remember, we're not discounting here, we're compounding. So we're taking $100 at time 1, and we are compounding it as we go forward. Then we're adding to it another $100 here at time 2, another $100 at time 3, and so forth. That's how we end up with 481 right where they cross. And that too is the payback for the discounted payback rule. Now the total present value, or sorry, the total future value of the cash flows is out here at 642. And we can compare that to the future value of the cost of the project being 541. And that tells us that, yes, the NPV is going to be positive. Now, just a brief summary of payback. While it now includes discounted or time value of money, it's also still easy to understand. It does not accept negative estimated NPV investments, and it's still biased towards liquidity. It may reject a positive NPV project because we still cut off before we account for all of the future cash flows, and it requires that arbitrary cutoff and ignores the future the cash flows rather beyond the cutoff date. And it's biased against long-term investments or projects, just as with the regular payback rule. Okay, so in this final example, when looking at discounted payback, we're going to compare a project using discounted payback and compare that to using an NPV rule. So this particular project costs us $400 at the outset. Oops, what happened to my pencil? And okay, now it's connected, and there we go. This particular project costs $400 and will pay back $100 per year forever. So this can be considered a perpetuity, right? And we can very easily value that perpetuity for the NPV rule because we take account of all cash flows with NPV rule. That perpetuity is the periodic cash flow divided by the required rate of return, and that is, in this case, 20%. So when you take $100 and divide it by 0.2, we get a $500 present value for the infinite series of $100 payments every year. Subtract from that the $400 cost, and we have a positive NPV of $100. So that would, using the NPV rule, say that we take that. Now, discounted payback, we still need to get the discounted value, but what we don't know is how many periods do we go out before we get basically $400 of discounted value, which would then be equal to the $400 cost of the project. So I think using the financial calculator is the quickest way to come up with the discounted payback. And here what we would want to do is we're going to be solving for n. So we can put in our discount rate of 20% per period, per year in this case. We can put in our cost of $400 as a present value. And we can put in our payment of $100 every year. And note that I made the present value a negative 400 and the payment is a positive 100, and I'm just going to zero out the future value just to make sure that it's clear, and then I'm going to compute the n, and I get 8.83 years is what it would take. So let's go back to that slide, and here we have, yes indeed, the authors did the same thing, and they came up with a little less than 9 years is the discounted payback. So if our discounted payback rule said we only take projects with a discounted payback of 5 years or less, we would reject this. If we said we take payback with a 10-year or less, then we would accept this. But generally speaking, you get the idea. Now we move into another method, which again is one of those methods that is used by practitioners, but it's not a good idea for some different reasons than the payback rule is problematic. This one is called the average accounting return. And actually, the tip-off is in part that we're talking about accounting numbers as opposed to cash flows, and that's one of the weaknesses of this method. But let's walk through this and see what we do here. So suppose that we're opening up a new store, and the cost to renovate the space is $500,000, and the store has a 5-year life. And then everything reverts back to the owner of the mall at that point. The required investment would be depreciated over 5 years on using straight line. So we would have a depreciation of $100,000 every year. We have a tax rate of 25%. And so we're going to look at what those numbers turn into on an income statement. And so here you see we've got some revenues listed. For each year, we have expenses related to those, and then we subtract from the earnings before depreciation. We subtract the depreciation, we get earnings before taxes, and then we calculate our tax bill and subtract that, and we get ultimately a net income of $100,000, $150,000, $50,000, $0, and a negative $50,000. So those are our future cash flows. And so we can take those and just add them all up and divide by the number of years. That's the average, right? And we're using accounting values. That's, in this case, net income. And we get an average net income of $50,000. Now, what is the average book value? Well, our asset base is assumed to be $500,000 at the beginning of the period, and we depreciate it straight line all the way through to 0 at the end of 5 years. So the average book value is $500,000 plus the ending value divided by 2, and we end up with $250,000 as the average book value. Now, we want to take that average book value and divide the average net income by that average book value, and we get 20%. Now, once again, we have some sort of target that we would use. If our target is less than 20%, then this investment is great because it generates a higher return than our target. If our target is greater than 20%, then we would reject that project. We have many problems here. One of the problems is that AAR is not the true rate of return. It ignores time value of money. Again, same problem we had with Payback. It ignored time value of money. It also lacks any sort of objective cutoff period. The target for the AAR may be specified by calculating AAR for the firm as a whole, but even that, again, does not take into account time value of money, and it's accounting returns, it's not, or accounting figures, it's not cash flows. And so all of these things add up to be a problem. The advantages are it's easy to calculate. The information is widely available off of the financial statements or pro forma financial statements. The disadvantages is that it's not really a true rate of return, and time value of money is ignored. Major deal. Uses, again, an arbitrary benchmark as the cutoff rate. And then it's, as I mentioned already multiple times here, it's accounting numbers, not cash flows. So now let's turn our attention to some more reasonable methods. This internal rate of return is widely used in the real world and largely is going to give you answers similar to what you would find with NPV, with a few exceptions. We'll talk about those exceptions, and there are actually some methods that have been developed to get around some of these problems. I'll show you what those are in just a moment. But when we talk about internal rate of return, we're talking about a return which is very attractive to practitioners when they're thinking about a project. If I can tell you what the yield is going to be on a project, that's a helpful thing. It's not just does it exceed a particular yield, but actually what is that yield? And that's really what internal rate of return is going to give us. So if we have, in this particular example, very simplified example, let's suppose that we have $100 today, and in 1 year, that project that costs $100 is going to yield $110 in return. And of course, that's a 10% yield, right? You can tell that just by looking at the numbers. That would be the internal rate of return on it. Now, what are we actually doing here? Well, really what we're doing is we're calculating a required rate of return assuming that our NPV on the project is 0. So let's look at this down here. Here's the way we would calculate an NPV, right? We start off with our cost, cash outflow of 100. We have a cash inflow of 110, and that's going to be discounted back to times 0 at R. Right? If this were just a normal NPV problem, we'd just run that math and we would end up with a value of, well, depending upon our R, we would end up with a value either negative or positive. If the R was at 10%, we would end up with a 0. If it was higher than 10%, we would end up with a negative value. If it was lower than 10%, we would end up with a positive NPV project. But when we calculate an IRR, what we're going for is we're looking for the rate of return that actually sets NPV equal to 0. So instead of plugging in an R and solving for the present value and then netting it out with the cost, what we do is we assume that the NPV is 0, and then we solve for our R. Now, in this case, we can solve directly for R, and we get that R is 10%. All right. In cases where we have multiple cash flows, it becomes more problematic as to how we solve for that R, and it's done actually by trial and error. In fact, we'll see that here on this example, where we have a project that costs $100 and it yields $60 over the course of the next 2 years. So here's our first payment, here's our second payment, and if we set this problem up in the same way that we did with the prior problem, here's our cash outflow. Here is the first cash inflow discounted at some rate for 1 period. Here's the second cash flow discounted at that same rate for 2 periods. Now we're setting all of that equal to 0, and we're looking for a rate of return, or an IRR, that makes that equality hold. There's no easy formula to do this. Even your calculator is solving it by trial and error. If we were to plug in, say, a discount rate of 0, we would end up with $20. That's not 0, so we try a higher discount rate. Let's try 10%, and we see that when we use 10%, that yields an NPV of 4. So we're headed in the right direction. It actually needs to be higher than 10% to get the NPV down to 0. And we keep doing trial and error. And we notice here that between 10 and 15, the NPV goes from positive to negative. So we know that the internal rate of return that sets the NPV equal to 0 is somewhere between 10 and 15%. And if we were to plug this into a financial calculator, we'd see that it actually turns out to be an internal rate of return of 13.1%. And we can actually do that here. Let me open up my calculator, and we'll plug in the figures. Let me clear this off, and let's see what we can do here. So we have cash flows of $60. That's our payment. We're going to zero out the future value just to make sure that's cleared. And then we have a cost of 100. Plug that in. We have 2 years is the length of our project, and we solve for the I, and we get the exact IRR is going to be 13.0662 in that particular project. All right, let's go back to the slides here. Now, depending upon what our actual cost of capital or required rate of return is, we'd either accept or refuse this project. If our required rate of return was less than 13.1, we would accept this project. If it were higher, we would reject this project. Now, how do we look at IRR relative to NPV? This little graph here is quite helpful at doing that. So this is actually called an NPV profile. And what we're doing here is we're calculating the NPV at different discount rates. We have NPV here on the y-axis, and we have different discount rates here on the x-axis. So when we calculate it at 0 IRR, that's where we get that 20 NPV. If we used 5 as our discount rate, we would get something just north of 10 as our NPV. 10% discount rate is going to yield something less than 5. And then we see where it crosses the x-axis right here. That is our IRR. That's our 13.1. Anything above that is going to yield negative net present values. So at 15% and at 20% is going to be negative all the way on up. Everything else is going to be negative going above 13.1%. And by the way, just let me reiterate this. This diagram right here is known as a net present value profile. Very useful things. Even if we're doing an NPV method, it's useful to take a look at the NPV profile so that we see how close are we to falling into losing money on this project. And so many times you'll see analysts looking at this profile to just get some sense of what's the slope on this line. Is it a slope like that, or is it a gentler slope, or it gives you a better sense of how sensitive the project is to our estimates of cash flows as well as discount rates. Here's another example. In this case, we have upfront costs of $435.44. And then we've got cash flows, and that's a negative. We've got cash flow of $100 discounted at some rate for one period. We've got the next cash flow is $200 discounted at that same rate for 2 periods. And then the final cash flow is $300 discounted at R for 3 periods. So when we solve for R, we find that actually this 15% R is equal to 0.15 or 15%. So that 15% is what sets this series of cash flows exactly equal to the cost of $435.44. All right. The reason that this negative NPV could occur is if we had a 18% required rate of return, but we've got an internal rate of return of only 15, that means it's not high enough. So it would yield a negative NPV, and we would not take the project, whether we're using IRR or whether we're using NPV. We would come up with the same answer: do not take the project. Now, if we had a rate below 15%, we would take the project. That would generate, of course, a positive NPV, and any required rate of return below that 15% level is a project that we should take. Now, here's one of the problems that I alluded to earlier with internal rates of return. If the signs change on the cash flows over the time period more than once, we're going to have multiple possible internal rates of return. Hold on. I know it sounds weird, but it's true. Here's an example. So suppose that we had an initial investment of $60. Our cash flow at year one is 155, and we have another cash flow at year two, which is another investment. So signs changed between these two periods, and they also changed between these two periods. So we now have two sign changes. And that can be problematic. So what we're going to find here is when we start doing our trial and error method to solve for an internal rate of return, if we look at this table down here, we start at 0%. Of course, we get a negative NPV. At 10%, we get a negative NPV. At 20, we get a negative NPV. And then at 30, it turns positive. But at 40, it goes back to being negative. So what's going on here? This is strange. Well, the NPV profile that we mentioned earlier is going to help us out tremendously here when we look at this. So let's look at this NPV profile. So here's what we were calculating. At 0 NPV, it's a negative $5. At 20%, it's still negative. But at 25%, it becomes 0. And above 25%, but below 33 1/3, it becomes positive. And then after we hit 33 1/3, it goes back to being 0. And above 33 1/3, it goes back to being negative. So really, I mean, there's one little span in here between 25% and 33 1/3% where that thing has a positive NPV. So if we had a required rate of return in between those two values, we would take this project. If we had a required rate of return below 25%, we would not take the project, or above 33 1/3%, we would not take the project. I know, it's weird, but check the numbers. Try it yourself. See what you get. These are simple enough numbers to plug into a spreadsheet or even to do by hand. And you'll see that these are the numbers you get. So it's the sign changes that are key here. We go from negative to positive, and then from positive back to negative. And that means we could have at least two internal rate of returns that give us a 0 NPV. And we see that right here. Now, which one is right? Well, the answer is we don't know. They're both right. And anything in between those is actually a project we should do if our required rate of return is between those. But anything outside of that, and some projects are like this. I know you might think, well, when would we ever have a negative cash flow at the end of the project? Well, think about any sort of extractive industry. You've got a lot of major cleanup afterwards. I know oftentimes that gets socialized. In other words, the private corporation has walked away or gone bankrupt, and that becomes a problem for society to clean it up. But properly, it should have been done by that private corporation, and they probably shouldn't have taken the project to begin with. And they may well have known that. I mean, think about it for just a second, and it doesn't take long to figure out that that's the case. I mean, we are here at John Carroll. We should have some ethical perspective about what sort of projects we take, and, are they projects that are actually going to overall produce a positive result, not only for the firm, but also for society as a whole. All right. What's the IRR? Well, we're looking at an investment that requires us to invest $51 today, and you'll get $100 back in a year. But you must then pay out $50 in 2 years. So here we have another situation where the sign is changing twice. So we go from a negative 51 at time 0 to a positive 100 at time 1 to a negative 50 at time 2. But actually, this one gets even worse because there is no return where the NPV is 0. It is always negative. So in this case, there is no positive NPV at any cost of capital, at any required rate of return. And then there is no IRR that is positive either. So again, we can run into these situations, especially when signs change more than once. How many times are we going to, or rather, how many IRRs are we going to get? Well, there's a little rule. Descartes' rule of sign actually tells us how to do that. So it's the number of sign changes is the maximum number of internal rates of return that we could find. So if there were 3 sign changes, we could have up to 3 different IRRs. We won't have to have 3, but we could have up to 3. If there were 4 sign changes, we could have up to 4 IRRs. And again, we have no idea which one we should accept because all of them are valid. All of them are correct. They produce a 0 NPV. That's a real problem, right, folks? So what do we do about it? Well, in a minute, I'll give you that answer. Or at least I'll give you an answer. I'm not sure that it is a clear answer, but it is a means of avoiding these multiple sign changes. And as a result, that means that we can limit our internal rates of return to 1. It doesn't mean that it's going to be correct per se. And it actually still, after we've done some of these manipulations to the cash flows, we may as well just do an NPV and be done with it, right? Except people do like hearing rates of return and going, oh yeah, I love that rate of return. You know, that's much higher than I was expecting or than I required. All right. Suppose that we have mutually exclusive situations. Now, mutually exclusive means that they are not independent. Mutually exclusive means we have A and we have B, and we can only do one of those two. We can either do A or we can do B, but we can't do both A and B. If A and B were independent, we could do both A and B, right? So given 2 or more mutually exclusive investments, which one is the best? Well, is it the one that produces the highest IRR, 24% for A, and only 21% for B? So here's A. We have a cash outflow of $100, and then we receive $50, $40, $40, and $30 over the next 4 years. In B, we also have a cash outflow of $100, and it generates $20, $40, $50, and $60 over the course of 4 years. So this 21% is the R that causes the discounted value of these future cash flows to exactly equal 100. Likewise, 24% is the R that causes the discounted value of these cash flows to exactly equal 100. So do we always take the highest internal rate of return? Well, what if this same project, instead of being $100 of cash outflow, let's say it was just $1. And then we had 50 cents, we had 40 cents, and we had 40 cents, and we had 30 cents. That actually is going to produce the same IRR of 24%. But clearly, the cash flows are tiny fraction of what we have with investment B. So here again, NPV gives us a better answer because NPV tells us the increase in the value of our company if we take a particular project where we have 2 mutually exclusive projects. So do we want something that is going to generate $1's worth of value? Or do we want something that's going to generate $100 worth of value? If we can only take one of those, the answer is, of course, we want the $100 of value generated for. That means the value of our company goes up by $100 rather than $1. I know this is an absurd example, but even, we could put these numbers a little closer together. Maybe $50 for investment A instead of $100 for investment B, and we'd still end up taking investment B if they are mutually exclusive. In other words, if we could only do one of these. And this just goes on to tell us that same sort of thing. I'm not going to spend any time on this particular slide. Now, we can look at these two projects, again, using our handy-dandy NPV profile. And what we see is that over here, we've got investment A, and we've got investment B right here. And investment B produces a higher NPV for all values where the required rate of return is below 11.1%. Now, 11.1% is actually known as the crossover rate, and that is where the two projects have exactly the same NPV, and then they cross at that point, and beyond 11.1%, above 11.1%, project A, investment A, has a higher NPV than project B. So if we had a required rate of return above 11.1%, we would take project A. If we had a required rate of return below 11.1%, we would take project B. And of course, the example that I made up where project A has a much lower NPV, we would almost, in that case, we would take project A, we would take project B every time. All right, so how do we capture that crossover point? How do we actually calculate it? Well, I mean, the simple way is to simply do an NPV profile for each of the two projects, but there's actually a little trick here we can do. So suppose that instead of what we were looking at, suppose that we have these two projects. Again, they are mutually exclusive. In other words, we can only do one of the two. We can't do both. And notice that project A only costs $400 relative to project B's cost of $500. And then they generate different cash flows as well. Project B's cash flows are higher than project A's, and so is its cost. So to figure out that crossover point, why don't we take advantage of that difference? We could take that marginal difference and find out where its NPV is zero, at what rate its NPV is zero, and it turns out that's going to be our crossover point. So what's the difference here? We've got $100 difference in the initial cash flow. We have a $70 difference between cash flows at year one between A and B. And then we have, a $60 difference, and these are both positive. We have a $60 difference between the cash flows for year two. So why don't we take those cash flows, negative 100, positive 70 in 1 year, and positive 60 in 2 years, and figure out the internal rate of return that makes that NPV equal zero. And it turns out that the IRR that makes that equal zero is 20%. Okay, so here we have two projects who have identical cash flows, but the signs are opposite. So project A is a normal investment project. It's a cash outflow at time 0 and a cash inflow at time 1. Project B is a financing project, actually. It has a cash inflow at time 0 and a cash outflow at time 1. So we're basically borrowing at time 0 and we're paying it back at time 1. The IRR for both projects turns out to be 30%. Right? Now, let's look at their NPV profiles here. So project A has an NPV profile where anything below that 30% rate is a positive NPV. So if we have a required rate of return below 30%, we would take on this project. Project B, on the other hand, only has a positive NPV where the required rate of return is greater than, oops, that should be a greater than sign, is greater than 30%, right here. Anything over here is a negative NPV. So when it comes to a financing type cash flow, we should only take it if it's an inexpensive source of financing. In other words, if the IRR is lower than the required rate of return. So if the IRR is lower than that, here's the IRR, and so the required rate of return must be somewhere up here, must be higher than the IRR. And then we would take on that project. Okay, so, IRRs are nice because people like to think in terms of returns. What am I getting for my investment? What kind of return am I getting? Is it 5%? Is it 10%? Is it 20%? Is it 30%? That's a nice number to have. The downside is, of course, we have potential for multiple IRRs, and we also have this potential where we might have a reversal in a financing situation where we want a required rate of return above the internal rate of return. That's problematic. There are some solutions to this. And there's this thing called modified internal rate of return, MIRR. And there are multiple ways that we can modify the cash flows in order to remove those multiple internal rates of return that we receive when we have the sign changing more than once. All right, so here's an example. We have a cash outflow of $60. We have a cash inflow of $155 at the end of year 1, and another cash outflow of $100 at the end of year 2. So this will generate potentially 2 internal rates of return. And in fact, it turns out that it'll generate these two, 25% and 33.33%. All right, so what can we do to resolve that problem? Well, we can get rid of one of those sign changes. A couple of different ways we can do that. One of them is we can take this cash flow, this outflow, or any outflows, as many as we have, and we can discount them back all the way back to time 0 and add it to the initial cash outflow. You might ask, well, what rate do we use? And that's one of the problems here, right? We don't know the rate to use here. We don't know the internal rate of return. So what do? Well, why don't we take the required rate of return and use that? In this case, let's say that the required rate of return is 20%. So we're going to move that $100 back 2 periods to time 0 and add it to the $60 investment. We're going to have a total of $129.44 of investment. So then at time 1, we have $155 cash inflow. So here's our new timeline. And there's nothing out here at 2, so we don't even need that. So now there's only one sign change, and we can calculate an internal rate of return, and it turns out to be about 19.74%. Now, if our required rate of return actually was 20%, this is a project we wouldn't take. How else can we deal with that? Well, we could reinvest our positive cash flows and move those out to the end of our timeline. So what we're doing here is we're going to take our timeline again. We've got a cash outflow here, cash inflow here, and another cash outflow here. We're going to move this cash flow right here. We're going to move it out to the end of our timeline and add it to the cash outflow. And again, what rate do we use? Let's use our required rate of return. So here we have doing that $155 times 1.2 plus the negative $100 gives us a new cash flow of $86. So now our timeline looks like this. Negative $60 and positive $86. Only one sign change again. And we can calculate an IRR, and it turns out that that IRR is 19.72. And again, I'd recommend that you try this out for yourselves in a calculator. We could do this, let's see, negative 60 and positive 86 2 years from now. So let's run this one and just take a look at it. All right, so we've got $60 negative, oops, why did that not work? 60 negative, and that's our present value. I'm going to zero out the payments, and then we have $86 positive, and that's our future value. Let me flip this around so these you can see everything better. All right, we have 2 periods, and that's all we need. And now we compute our interest rate, and there we go. That's our 19.72% that we saw on the slide as well. And hang on a second, let me get back into this. All right. So double check some of these. Have your calculator along, stop the video, and just make sure that your numbers correspond. If not, go back and double check things. Yet another means of dealing with this. So suppose that we do a combined effect. So we move the negative cash flows back to time 0. We move the positive cash flows out to the end of the period, and then we calculate our IRR. So here we're taking that $100 and moving it back 2 periods, and that's our $129.44. We're going to move the $155 out to the last period of our project, time 2, and that means we have $186 out there. So again, if I were to look at this on our timeline, and this would be a positive 186 out here. And again, if we plug those into our financial calculator, we'd come up with a internal rate of return of 19.87%. So these are methods that can be used to avoid that multiple IRR problem. They're far from perfect. And again, since we're using a required rate of return, then we obviously know what it is. Why don't we just do an NPV and forget all this nonsense? And many times that's what people will do. But you know, the average person is still really finds that rate of return highly attractive. So it is what it is. This discussion is something that I just won't beat the dead horse here. You can stop and read it if you want. Now, the last element, or the last criteria that we're going to look at would be profitability index. And profitability index is kind of think of it as kind of a variation on the NPV. Again, I'm not sure why we would do this, other than maybe it makes more sense to people. But essentially what we're doing is we are taking the present value of the future cash flows and dividing it by the initial cost. Remember, on NPV, we're taking and we're subtracting the initial costs, and present value of future cash flows. Whereas on PI, on the profitability index, we're taking the present value of the future cost and dividing it by the initial cost. Anything greater than 1 is a positive NPV, and we would do the project. The more above 1 it is, the better off, or the greater the increase in the value of the firm is. Again, it's a variation on a theme here, and why not just use NPV? Because it really tells us the increase in the value of the firm. Remember, the firm is simply the sum of the NPVs of all of the projects that that firm has undertaken. Advantages of this profitability index: it's closely related to NPV. It's easy to understand. May be useful when available investment funds are limited. So there we would look for, the highest PI is the one we would take if we had mutually exclusive projects. Now, in practice, one last thing to mention: a disadvantage. It still only tells us relative. So one project has relatively higher returns than another. It doesn't tell us the size of that NPV. So the disadvantage of profitability index is that if we are dealing with two mutually exclusive projects and we get, say, 1.2 and a 1.3, we'd be tempted to take the 1.3, but we still don't know. Since we're scaling it by initial cost, we don't know what that initial cost is. Are they different? If they're different, then this project might actually yield a higher NPV than this project, right? And it could be that we still want to take this project because, remember, the highest NPV is the biggest increase in value of the company because the company is simply the sum of the project's NPVs. I think I've said that enough times. Hopefully you get that and remember that. It's important. All right. So in the practice of capital budgeting, there are a variety of methods. All of the methods that we've looked at are methods that are still used to this day. And sometimes companies will use multiple methods to look at a project from different perspectives. If you really want liquidity, if that's your thing, and you're worried about liquidity, then having a payback or a discounted payback is not a bad thing to look at. Now, you still probably wouldn't take the project even if it had a payback, but it had a negative NPV. But it helps to get a different feel for what's going on. And if you're trying to give management some sort of idea of what this thing is, what the return is, which is something that non-finance people are going to be better able to understand, you might actually calculate an IRR for them and give them some sense of the actual return on the project, but still do an NPV as well, just to make sure that you're not doing a negative NPV project. Now, there was a survey that was done in 2022, and this was of CFOs, Chief Financial Officers. So these are folks who should know what's going on. They probably got an MBA. They've probably been trained in a business school somewhere, and they've probably seen all of these techniques. And we're talking, 2 years ago from the time I'm recording this lecture, so it's not ancient history. The example I gave you from my experience with Glastron Boat Company was well over 40 years ago. Yeah, about 40 years ago. But look here. So this rule, the NPV rule, 77% of CFOs of large cap firms said that they use the NPV rule, and that's good. Well over 3/4 of CFOs of large cap firms are using NPV. Thank goodness for that. But look at the small firms, and I'm not sure how they define small versus large, but smaller firms, only 40%, less than half, less than half still today are using the NPV rule. They were educated since we've known that the NPV rule is the most efficacious rule to choose a capital budgeting project. But less than half of them use it. IRRs, about 3/4 of large firm CFOs will do an IRR as well. Obviously, they're doing multiple methods. If these add up to much greater than 100%, so they're doing multiple methods. And only 40% of small firm CFOs do internal rate of returns. This is the one that really is shocking to me. 2/3 of small firm CFOs still use the payback rule. Now, obviously, they're looking at multiple rules, but it's pretty shocking to me that there's so many. And look at the large firms, it's about the same percentage. Thankfully, they are probably more reliant upon NPV, but who knows? Now, the least used would be this profitability index, which I don't understand why that's less used than the accounting rate of return. The accounting rate of return has multiple issues, not the least of which is that they're not cash flows. They're accounting flows. And not to mention the fact that we're not looking at the real all of the cash flows, and we're not timing them when they occur. We're just using, looking at the accounting profitability. And so that's a terrible rule. But still, more than half of large companies use that, and 44% of small companies use the accounting rate of return to analyze projects. I'm not going to go back through this with you. This is the end of the chapter, and this provides just a summary of the various techniques. So if you want to read back through this, just stop the video. I'm going to slide on to the next slide here, where we look at modified IRR and the profitability index, and then look at payback criteria, both the standard payback with nominal cash flows, and then a discounted payback where we have discounted cash flows. And that is about it for Chapter 9. So hope you enjoyed the chapter, and I hope that you will change some of these numbers back here, and hopefully most of you will actually choose to use the NPV rule. Maybe this number will go up, and this is the one that I really want to see go up. That should be at least the same as the large firms. And the large firm number should go up towards 100% too. Everybody should be using this rule. It's ridiculous not to. Now, do you want to use some sensitivity analysis when you do this? Absolutely, 100%. Use some sensitivity analysis, because we're estimating cash flows with error. Our timing is with error as well. And yet the sensitivity analysis is relatively easy to do. There are some plugins for Excel where we can do Monte Carlo simulations, and we could model this and then run Monte Carlo simulations on it and get a really good sense of just how good our estimate of NPV is, how many outcomes actually turn out to be positive versus negative. And that's a very useful thing. Not only can we model the cash flows as a distribution instead of a point estimate, but we could also model the discount rate that we use. And that would provide us with a fairly robust estimate and some statistical significance that, hey, if we do this project and my estimates are close, I'd be able to say, with 95% confidence that we will have a positive NPV project. Or maybe I could say that, 7 times out of 10, the NPV is going to be positive on a project like this. Anyway, that's it from me, and hope you enjoyed it, and see you in Chapter 10. Good night.